Okay, so you want to own a cannabis store in Canada. It's 2025. The country legalized weed 7 years ago. The market generates $5.5 billion in sales every single year. You walk into a dispensary, look around at the customers, do a quick calculation in your head. A few hundred transactions a day, $40 average basket, that's maybe $4,000 in sales on a Tuesday afternoon. Multiply that by 365 days. You're looking at over $1 million a year from a single location. Sounds like the greatest business opportunity Canada has produced in a generation. It is not that simple. And by the time we're done here, you're going to understand why owning a cannabis store in Canada is one of the most misunderstood and most brutally difficult businesses in the country right now. Because the real story isn't about a $5.5 billion market, it's about who actually keeps that money. And the answer is going to change how you see this industry forever. Canada legalized recreational cannabis on October 17, 2018. It was a historic moment, the first G7 country to do it at the federal level. Entrepreneurs across the country saw the same thing, a brand new legal market, billions of dollars waiting to be captured, and a product that Canadians had been buying illegally for decades suddenly becoming available through legitimate retail. The narrative was irresistible. You open a store, you sell a product people already want, in a market with essentially no established competition, protected by a government licensing system that limits who can participate. It sounds like a license to print money. And the numbers seem to back it up. Today there are 3,761 licensed cannabis stores across Canada. The market did $5.5 billion in legal retail sales in 2024 to 2025, up 6.1% from the year before. The industry employs tens of thousands of Canadians. It generated $2.5 billion in government tax revenue and profits in the same period, a number that grew 11.5% year over year. From the outside, it looks like a thriving industry in full expansion. Now let's look at it from the inside. Because what most people don't know about the Canadian cannabis retail landscape is this. Half of all cannabis retailers in Canada are micro businesses with 1 to 4 employees. Not small businesses, micro businesses. One person behind the counter, maybe a part-time employee on weekends, running what amounts to a specialized corner store in one of the most heavily regulated industries in Canadian history. This is not the image of a booming sector. This is the image of a fragmented, exhausted market where thousands of individual operators are competing for margins so thin that the slightest wrong move ends the business. And before you can make your first sale, before you can open your doors, before a single customer walks in, you have to survive the licensing process. And that process is the first place where the dream starts to crack. Most people assume getting a cannabis retail license in Canada is a straightforward government process. You apply, you pay a fee, you wait, you open. The reality depends entirely on which province you're in, and the differences between provinces are so dramatic that they tell the entire story of why this industry looks so different across the country. Let's start with Alberta, the most open market in Canada. Application fee, $400. Annual license renewal, $700. Security deposit, $3,000 for background checks. Total to get licensed, under $5,000. This is why Alberta has over 700 cannabis stores, or the second highest in the country, and why the barriers to entry are the lowest of any province. You can be a first-time entrepreneur with limited capital and still get through the door. Ontario is different. License fee for the operator, $6,000. Authorization for the specific retail location, $4,000. Minimum upfront government cost, $10,000. Renewable, non-negotiable. And if your application gets rejected, for any reason, you don't get it back. British Columbia sits somewhere in the middle at $7,500 for the application plus $1,500 per year. But BC also has a rule that no single company can own more than 8 cannabis retail locations, an anti-monopoly cap that Ontario and Alberta don't have, which means the BC market stays more fragmented but also more protected for independent operators. And then there is Quebec. Quebec has no private cannabis retail license available, none. The provincial government decided in 2018 that cannabis retail would be a complete state monopoly operated through the Société Québécoise du Cannabis. The SQDC. If you want to open a cannabis store in Quebec, the answer is no. It is structurally impossible. But here's why that matters for your business plan, and why the Quebec model is the most important number in this entire story. We'll come back to it. Because what the SQDC is doing compared to what private retailers are doing everywhere else is the most uncomfortable contrast in Canadian cannabis economics. First, let's talk about what it actually costs to open a store once the license is secured. Because the license fee is just the beginning of a much longer bill. The license is approved. You have your authorization. Now, most entrepreneurs sit down and realize they've been thinking about the wrong number entirely. Industry estimates put the average cost of opening a cannabis retail store in Canada at approximately $300,000. That breaks down roughly like this. Renovations to meet Health Canada's strict physical requirements, secure storage, specific lighting, layout configurations, run approximately $85,000. Security systems mandatory under federal law, cameras, safes, alarm systems, access controls. Add another $37,500. Opening inventory to stock the shelves with enough product to actually run a business, $40,000. First and last month's rent plus security deposit on a commercial space in a viable location, anywhere from $20,000 to $80,000 depending on the city. Marketing, signage, staff training, point-of-sale systems certified for cannabis compliance. Another $30,000 to $50,000. You're at $300,000 before you've opened the door. And that's the average. In Vancouver or Toronto, where commercial real estate is among the most expensive in North America, the number climbs well past $500,000. Now here's what a realistic financial model looks like for a store of 2,500 square feet doing $2.9 million in annual sales, which would make it a above-average performing location. Gross margin after the cost of product, approximately 29%. That gives you roughly $841,000 in gross profit. Then come the operating expenses, rent, staff, insurance, compliance costs, security, software, marketing. By the time you've paid everything, your net margin is approximately 9%. On $2.9 million in sales, that's $261,000 in net profit before tax. That sounds workable, until you remember you invested $300,000 to open the store. At $261,000 per year in net profit, your payback period on the initial investment is over 13 months in the optimistic scenario. And this assumes your store is doing $2.9 million in annual sales. Most aren't. But here's the problem that nobody talks about when they run these numbers. The 9% net margin assumes you have a bank account. And getting a bank account as a cannabis retailer in Canada is not as simple as walking into your local branch. You are running a fully legal business. You have a government-issued license. You pay taxes. You follow Health Canada regulations. You employ Canadians. And your bank might refuse to work with you. Canada's major chartered banks, RBC, TD, Scotiabank, BMO, CIBC, have historically been extremely reluctant to provide standard business banking services to cannabis retailers. The reason is international exposure. These banks operate in the United States and in global markets where cannabis remains a controlled substance under federal law. Accepting cannabis revenue creates compliance complications they have chosen to avoid. What this means in practice is that many cannabis store operators in Canada operate primarily in cash, not because they're hiding anything, because the financial system treats a legal Canadian business like a liability. No standard business loan, no line of credit from a major bank, no payroll software from the major providers who exclude cannabis businesses from their terms of service. You are a legal enterprise running on cash, processing payments through specialized fintech solutions that charge higher fees than standard merchant services, and financing your operations through personal capital or private lenders at rates no traditional SME would accept. This is not a minor inconvenience. It is a structural disadvantage that affects every financial decision you make from the day you open. And it sits on top of a tax structure that was designed theoretically to support the industry, but in practice has been quietly extracting from it ever since day one. In January 2025, a document from the New Brunswick Department of Finance obtained through an access to information request by a cannabis producer, revealed something that should have made front-page news across the country. After 5 years of legalization, not a single licensed cannabis producer in Canada had been consistently profitable, not one. And a large part of the reason is the federal excise tax. Here's how it works. The federal government charges an excise tax on cannabis that is supposed to represent 10% of the sale price. But there is a floor, a minimum of $1 per gram, regardless of what the product actually sells for. In the early days of legalization, when cannabis was selling for $10 to $12 per gram, a $1 excise tax was 8 to 10% of revenue. Painful, but manageable. Then the market evolved. Competition intensified. Prices collapsed. Today, the weighted average wholesale price for dried cannabis flower in Canada is $3.80 per gram. For bulk formats, it drops to $2.85 per gram. At $3.80 per gram, a $1 excise tax is not 10% of revenue, it's 26%. The CEO of Crystal Cure, a New Brunswick cannabis producer who shut down his facility in 2024, testified that the excise tax represented up to 35% of his revenues in the months before closure. 35% of revenues going to a single federal tax, before rent, before staff, before electricity, before packaging. And packaging is its own problem. Federal law requires cannabis to be sold in child-resistant packaging that meets specific technical standards. For small format products, pre-rolls, small edibles, the cost of the packaging sometimes exceeds the cost of the product itself. The legal cannabis entrepreneur in Canada is not competing on a level playing field. They are competing with one hand tied behind their back by a tax structure that was designed when prices were high and never adjusted when prices fell by 40%. And the entity they're ultimately competing against, the one that benefits most from all of this, is the government itself. This is the part of the story that most Canadians have never seen laid out clearly. Let's compare two cannabis markets within the same country. Ontario, the most open, most competitive cannabis retail market in Canada. 1,799 licensed private stores as of 2024. Total Ontario cannabis retail sales, approximately $2.15 billion. Revenue per store, roughly $1.2 million per year per location. Quebec, complete government monopoly. The SQDC operates exactly 110 stores. Total SQDC sales for 2025 to 2026, $809.5 million. Net profit for the Quebec government, $132.4 million. Revenue per store, approximately $7.4 million per year. Read those numbers again. Ontario private retailer, $1.2 million per store. Quebec government monopoly, $7.4 million per store. The SQDC generates 6 times more revenue per location than the average Ontario private retailer, with 110 stores versus 1,799, and pockets $132 million in net profit. Money that goes directly into Quebec's public coffers. The private entrepreneur in Ontario is fighting for $1.2 million in annual revenue against thousands of competitors, paying excise taxes, operating in cash, unable to get a bank loan, managing a supply chain controlled by the government wholesaler, while in Quebec, the government runs a lean, unchallenged monopoly that generates transformational profit per location. The message is uncomfortable and clear. In the cannabis industry, the most profitable operator in Canada is not a private entrepreneur. It is the government. And in the provinces where private retail is allowed, the government is simultaneously your regulator, your wholesaler, your tax collector, and your most dangerous competitor. But even understanding all of this, even going in with your eyes open, there is still a market dynamic that is destroying businesses that did everything right, and it has been building since the first store opened. When Canada legalized cannabis in 2018, the assumption from government, from investors, from entrepreneurs, was that the illegal market would gradually disappear. Why would anyone buy from a dealer when you could walk into a clean, legal, government-regulated store and buy the same product with a receipt? 7 years later, the illegal market is still generating an estimated $2 to $4 billion annually in Canada. Depending on the estimate, it represents somewhere around 30% of total cannabis consumption in the country. 30%. After 7 years of legalization, and the reason is simple and brutal. Your dealer has no excise tax, no rent, no compliance costs, no licensed security system, no child-resistant packaging that costs more than the product inside it, no bank refusing to process their payroll. They sell a gram of cannabis for $8 to $10. Legal stores, and after absorbing all those costs, struggle to match that price while staying profitable. The legal market has been winning market share slowly, but it has been winning it by cutting prices. And cutting prices has compressed margins to the point where many retailers are operating at or below the break-even line, hoping that volume growth will eventually make the math work. For some it has, for many it has not. And the closure numbers from 2024 tell the story more clearly than any statistic. Most people assume the Canadian cannabis industry is still in growth mode. More stores opening, more consumers switching to legal, a market marching steadily toward maturity. Here's what actually happened in Ontario in 2024. 234 new cannabis stores opened. 214 cannabis stores closed. A closure rate that increased 52% compared to the previous year. Toronto, the largest cannabis retail market in the country, a city once described as the capital of Canada's cannabis retail revolution, lost 43 dispensaries in 12 months. An 11% decline in the number of stores in a single year in a city of nearly 3 million people. Fire and Flower, one of the largest cannabis retail chains in Canada, publicly traded, backed by institutional investors, filed for creditor protection in June 2023 after losing money every single year since its founding. Not one profitable year, not one. Tokyo Smoke, one of the most recognized cannabis retail brands in the country, the brand that was supposed to prove premium cannabis retail could work, closed 29 locations in August 2024 and filed for creditor protection. It kept 167 stores operating, but 29 locations that had staff, inventory, leases, and customers simply stopped existing. These were not poorly run businesses started by people who didn't understand the industry. These were capitalized, professionally managed retail operations with experienced leadership teams. They had access to capital that the average independent operator will never see, and they still could not make the math work. Which brings us to what the math actually looks like for the individual who opens one store with their own savings and walks in thinking they understand the business. The optimistic scenario. You open in Alberta, licensing costs under $5,000. You find a location in a growing suburb of Calgary with no competing store within 800 meters. You spend $280,000 getting the store open. Your first year is hard. You do $900,000 in sales. By year 2, you've built a loyal customer base. You're doing $1.4 million annually, and your net margin is sitting around 12%. That's $168,000 in profit before personal tax. You are working 60-hour weeks. You are managing staff turnover that never stops because cannabis retail doesn't pay well enough to retain people long-term. You are handling compliance paperwork that would make a lawyer tired. But the store is profitable. You are one of the lucky ones. The realistic scenario. You open in Ontario. You spend $320,000. License, renovations, security, inventory, first month's rent. 6 months after you open, a new competitor appears 400 meters down the street. Then another one. Your monthly revenue plateaus at $85,000. Your monthly costs, rent, staff, product cost, excise tax, insurance, compliance, run $79,000. You are making $6,000 per month before your own salary. You are operating primarily in cash because your bank account has limitations that make standard business banking impossible. You cannot get a small business loan to upgrade your store or expand your marketing, and the excise tax on your product eats a percentage of your revenue that would make any other retailer in Canada furious. By month 18, you are not losing money, but you are not building equity either. You are running a demanding, heavily regulated, cash-intensive business for a return that a salaried manager position at a bank would exceed, without any of the risk. The difference between these two outcomes is not passion. It is not hard work. It is not even business intelligence. It is market selection, cost structure, and a regulatory environment that varies so dramatically from one province to the next that the same business model can thrive in one location and slowly die in another. Here's what you now understand that most people standing outside a cannabis store on a busy Friday evening have never thought about. The 5.5 billion Canadian dollar Canadian cannabis market is real. The growth is real. The demand is real. But the money flows upward. To governments collecting excise taxes and generating monopoly profits, to provincial wholesalers who control the supply chain, to the federal regulator who charges fees for every license and every transaction. The private retailer, the entrepreneur who took the risk, signed the lease, built the team, and opened the doors, sits at the bottom of a value chain where every other participant has extracted their share before the net margin is calculated. Half of all cannabis stores in Canada have 1 to 4 employees. Fire and Flower never had a profitable year. Tokyo Smoke filed for creditor protection. 214 Ontario stores closed in 2024 alone. And not a single licensed cannabis producer in Canada was consistently profitable after 5 years of legalization, according to the government's own internal documents. The cannabis store that looks like a gold mine from the sidewalk is, for most of the people running it, a daily exercise in navigating a system that was never designed to make them rich. Canada didn't legalize cannabis to create a generation of wealthy entrepreneurs. It legalized cannabis to generate tax revenue, displace the illegal market, and control distribution. Those goals are being achieved by the government. The private retailer is the vehicle through which those goals are reached, not the beneficiary. The $5.5 billion market exists. The only question that matters before you sign a lease and spend $300,000 is how much of it was ever meant to be yours. Outfox the system.